Hey, this is Bridger Pennington, and you're listening to the Passive Investor Show.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to PassiveInvestorShow.com. Hey, PI listeners, this is John Fortes. I'm making it a point to speak to as many investors as possible. My goal is to position myself to be a blessing to my network through conversation. How could one be a blessing through conversation? The easy answer is by listening. A simple conversation can open many opportunities and doors. I always ask myself this: what do I have to lose by having one more conversation? Going back to high school, I've connected friends and family in my network to one another, even if it didn't benefit me. And I continue those same principles and practices. Why? Because it's the right thing to do. If I can't help you, I probably know someone or something that can probably solve your problem. I'd love for you to become a part of that network. Go to www.johnfortes.com, create your investor profile, and schedule a call. How can I best serve you through conversation? In the words of Clarence the Angel from It's a Wonderful Life, no man is a failure who has friends.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. Welcome back, everyone. Today, we have the pleasure of connecting with Bridger Pennington. Bridger Pennington is the founder of 3 investment funds that has done over 317 deals in the last 3.5 years. Bridger has started helping others launch their own funds through Investment Fund Secrets, an online program to help people start investment funds without working on Wall Street or having an Ivy League degree. Bridger has spoken on stage to thousands of people across the United States, is on a mission to help entrepreneurs scale their businesses through launching their own funds. Welcome to the show, Bridger.
John, happy to be on here. It's going to be fun.
Hey, man, I love what you do for the culture because that's what we focus on here. So I felt like you were the perfect guest for this. So can you tell the audience a little bit about your background and how you got into this?
Yeah, so I'll go high level, and we can go deeper if you want, whatever. But just high level overview. I launched my first funds in my 20s. We can go into that story as well. I come from a unique family. So my dad is a co-founder of a deca-billion-dollar family of funds. He grew up in ghetto North Las Vegas, graduated seasoned Bs, had this awesome kind of rags to riches stories, figured out what funds were, and funds just transformed his life. And he taught me about funds. Was able to launch my own. He, by the way, has never invested in any of my funds, anything like that, but has been a fantastic mentor in my life. And then additionally, my brother is a securities attorney. So he does all the lies. Was formerly chief compliance officer of a $900 million fund, has done a number of different funds. So between the three of us, we've got a pretty good family of people to talk and ask questions on funds to figure things out. And so we decided to open up the curtain and let other people kind of see what's going on. None of us went to Ivy League schools. None of us did the Harvard route. None of us did the Wall Street route. We're just entrepreneurs that figured out this incredible vehicle of running a fund, and we've been able to scale them and do them. So it's been pretty fun. We can dive deeper into that as well, but that's kind of the high level overview.
No, I love that you touched on that, and that your dad is your mentor, who is very successful creating funds in his business, and he's also taught you. But also you guys have a little incubator with your brother that can write up these and understand these contracts and PPMs and documents to create these structures. But yeah, when did you start working with passive investors when you created your first?
Yeah, so I was like a lot of young entrepreneurs. I grew up in a very, I would say, middle-class household. I got into college, was super ambitious. I was the guy, watching the YouTube videos, doing the whole thing. So I got into college. I started 6 businesses my first 2 years of school. And I'm not just like business ideas. Like I actually started the business, made money, was getting employees like 6 different times. And we did everything. I mean, we were building websites for people. I did Forex trading. We did Chinese tutoring. We did real estate wholesaling. I mean, like you name like the online business, like I tried it, right? So I was like, okay, I'm gonna be a millionaire, let's do this. And finally, I had decent success. I did okay. And finally, my dad grabbed me by the ears and he says, Bridger, you're kind of like a chicken with your head cut off. I want you to go meet with one of my business partners. I think this guy can really help you. So I said, okay. So I set this meeting. I drive up to this dude's house and I pull up through this nice gated community. I remember I'm driving through this area and there's beautiful mansions. I'm kind of like, who's my dad's business partner? I mean, we grew up, my dad had a car with 300,000 miles on it. I mean, we lived in, I would say, a middle-class household. It was great. It was awesome. I loved it. And I pull up to this guy's house, this beautiful white home. It like cascades over this beautiful view. And I'm like, who is this guy? Get out of my car. I walk up to his door. I knock on the door. I'm a little bit nervous to meet him. And he comes to the door, Bridger, come on and welcomes me in. I walk in, there's the wine cellar and the grand piano and the pool in the backyard, and just the whole thing, right? So we sit down, we start to chat about business, entrepreneurship, the whole 9 yards. And I finally get to the point, I go, how did you get all of this? And I kind of point at everything, right? Like, how did you do this? And he kind of laughs and goes, it's actually funny, and not very many people ask me that question. And I was like, oh, shoot, I don't, like, am I not supposed to like ask people that question, right? I didn't know. He goes, no, it's fine. Let me dive into it. But I just don't get asked that very often. He goes, I was a lot like you in my 20s. He goes, I started a number of businesses, actually had moderate success. And then he goes, then I figured out the secrets of the ultra wealthy. And he goes, ultra wealthy families and people, they want their kids to go to the best Ivy League schools and they want them to go work in investment banking, consulting, and they hope one day they'll go work in hedge funds, private equity, or they'll come back home and run the family office. And he goes, I met a gentleman a number of years ago. He was one of the wealthiest people I ever met. He ran a private equity fund. And I said, I don't care how long it takes me. I don't care if it takes me 1 year or 5 years or 20 years. I was going to figure out what a fund was, how to put one together, and how to build one. And he goes, that's exactly what we did. He goes, me and your dad partnered up a few years ago. We launched our first fund. And he goes, at the time, he goes, we have $8 billion with a B, billion dollars of real estate under management in our funds. And I was blown away. And to put that in perspective, you think like Grant Cardone, I'm sure everyone knows who he is on here. Cardone Capital has what, 2 billion under management, something like that. At the time, they're 8 billion. So 4 times bigger than Cardone Capital is today. And today now they're well over 20 billion. And same asset class, multifamily, they're doing B, C class apartments, things like that. And anyways, I was intrigued. I wanted to learn more. And I've always heard, I'm sure you talk about this in your show, but and feel free to cut me off whenever you like. But you always got to find a mentor, right? I've always heard that for find mentor. So I said, hey, can you be my mentor? And he kind of laughs. He goes, Bridger, go talk to your dad. Your dad is a way better mentor than me. And he goes, and I go, no, we're kind of poor. Like, you're rich. I want you to be my mentor. And he goes, Bridger, me and your dad make about the same amount of money. And my chin about dropped to the floor. I was like, huh? I was like, come again? He's like, yeah, we're pretty much equal business partners in this. And I left the dude's house. I drove straight to my dad's house. And I was like, Dad, what the heck? Like, what's going on? Like, why have we been spending money? Like, are you really making this much money? Like, what's going on? Like, why can't I order dessert at dinner? Like, because it's too expensive kind of thing. Like, anyways, my dad kind of laughs and he goes, I like to save and invest my money. My business partner likes to spend his money, but yeah, we live these different lives. But yes, we run these awesome funds. And so long story short, my dad started to teach me about funds. And I sat down with him every Sunday night. We'd sit down, he'd whiteboard out how funds worked. And over the next, 6 months, year, 2 years, and put this together for me of how funds worked and still to this day teaches me a lot about funds. And I was very intrigued, and we can dive into more of that stuff and parallel funds and all sorts of cool, blocker entities, all sorts of fun stuff with funds. But I was working at a company, and I found an opportunity that I could start a fund inside of this company. Their clients needed funding for they needed financing. I said, hey, this would be a great opportunity for a fund. I talked to the owners of the business. They loved the idea. I talked to my dad. He loved the idea. We put together all the stuff for a fund. I got it all ready to go. And I'm ready to launch. I'm excited. And for whatever reason, I overlooked one of the challenges of a fund is raising capital. Right? And for whatever reason, I overlooked that. I just thought, I don't know why. I just thought it would be I don't know, got easy. And I was like, shoot, I got to raise some money. And I thought, well, my dad is rich. He likes to invest. He likes my fund idea. I'll just pitch my dad and my dad will invest in my fund. And so I remember it was a late Sunday night. I went and walked in my dad's home office, sat down. In my best pitch voice possible, I said, Dad, how would you like to be our first investor to our fund? And he kind of laughed and he said, Bridger, I have the money to invest, but your first investor is your hardest investor to find. And if I invest in your fund, it would ruin the experience of you raising money on your own. And this will be a crutch that you'll never be able to recover from. And he said, no. And he kicked me out and said, you got to go figure this out on your own. And I took him up on the challenge. And I remember kind of walking out of the office with my tail between my legs a little bit and took him up on the challenge. And I went out and I pitched everybody I knew. And my first little fund syndicate, I raised a whopping $49,000 for it. Teeny, probably one of the smallest funds to ever launch ever. And but it was enough to get started.
What were you using to invest with that?
So we were doing small short-term loans. These are loans, they're $2,000 to $5,000, small micro loans. They would last 3 weeks, 5 weeks, somewhere in there. So fast turn loans. But it was enough to get started. 49,000 was enough to get going in that level. And so we started, and I had 6 investors. They all put in 5, 10 grand, whatever each. It was just teeny amounts. And we went out, and our first fund, we got our investors a 64% return on their capital, which small dollar amount, but good return, right? And since then we launched our second.
That was the proof of concept.
It was proof of concept, yeah. And so since then we launched our second fund. We raised and deployed millions of dollars out of that fund, and then we've done well in that fund. Our investors I just sent money back to them and closed things out there. We've done very well. Now we're launching our third fund in a new asset class. We're going after big box stores and real estate. And anyways, that's been kind of the last 4 years of my journey, and it's been incredible to be a part of, and it's been awesome. That's kind of how I got started in this game, and I'm in the middle of it right now. We're going out, and we've soft raised about 18 million for this third fund. We're looking to raise about 50 over the next 6 weeks, and so we're going after it right now.
Now let's touch on that. What does that fund structure look like today compared to the ones you did in the past? And what are the criteria of investors that you're looking for going forward?
Yeah, great question. Our first, I call it a fund. It was really a syndication, and we were grabbing money from anybody that would, had a couple of dollars in their checking account, right? We were grabbing money from whoever and syndicating the money together. Second fund, we did a Reg D 506B fund, raising money from qualified clients actually only in that fund because of certain rules. We went after that one. And then our third fund, and for people listening, qualified clients have so you have a credit investor, and then above that you have qualified clients, and then you have qualified purchasers. So a credit investor, you guys are probably know this, but $1 million net worth, including your home, $200,000 a year or $300,000 a year with a spouse. Qualified client, $2.1 million net worth, including their home, and then above that is a qualified purchaser, $5 million net worth, including your home.
Now, do you need to use a third-party service to verify that they are a qualified investor?
In a 506B fund, so B as in boy, you do not. So they self-verify. Yep. They'll just check a box.
Yep.
Now, in our new fund, though, we are doing a 506C. So C as in cat. So in this fund, we need to verify. Yeah. So we're taking accredited investors in this fund. We have a verification company we use that helps verify. We have a letter. It's not terribly hard, but sometimes can be a kink. So this is my first time doing that, though. In my past stuff, it's always just been check the box. It's been really easy, but now we've got to verify investor accredited status. So that's how we're doing this one. Real estate fund. So we're setting up another management company as well to collect management fees on there. So a little bit bigger structure. We're still raising money domestically though. So we're not setting up international feeder funds, block grantees, nothing like that in this fund. So yeah. Does that answer your question?
Yeah, absolutely. Because I know the third party verification, when you start moving into the 506Cs and accredited investor status and such. So what does your onboarding process look like for a new investor that comes across you? Yeah,
great question. So now as of today, we teach we call it the fund launch formula. That's what we kind of teach inside of our groups and community. So we will, instead of most people traditionally, when they want to start a fund, at least this is what I see, is, hey, I've got a great idea. Step two, let's go set up the legal docs. Let's pay our lawyers $30, $50, $100,000, whatever it is. And then let's go raise some money. And we have kind of flipped the script on that. And just from learning from entrepreneurs is we'll find a great idea, great thesis. Step two is we'll put together the pitch deck, all the formation. And step three, we'll actually go and pitch investors early. We'll go soft pitch investors to get feedback, to get market testing. Do investors actually like this offering? Can we charge a 3% management fee, or can we charge 2% or 1%, right? What's the market? And we can adjust that according to what our investors like and don't like. And so what we've done right now, and just as of today, we had the great thesis idea about 4 months ago. We liked it. We put our team together. The last 3 months, we've been soft pitching investors. So these are people in our personal network. We are just throwing the idea out. Hey, if this all checked out, can we put you down for $500,000 or $250,000 or $100,000? And we've lined up, like I mentioned before, about 18 million in soft commitments, which who knows what that means, right? That might not convert into actually, might be a lot less, but at least we've gotten 18 million to say, yeah, you know what, if this all worked out, we're good. So right now, actually today, we're getting our final draft of our LPA PPM finished up. And then what we'll do is hopefully we file the money and we go back to those investors and say, okay, it's all up. Let's get actually subscription documents signed, get everything done and put in. And then from there, kind of back to your question, how are we going to solicit investors? We've got decent followings online and different just networks that we'll start going through. We're going to use a couple different platforms. We're going to try them out where investors can come through a software and see the offering, see the pitch, do the verification thing, see the whole pitch deck.
An investor portal.
Yeah. So we have a couple companies we're working with right now to set that up.
Yeah, absolutely. Very important. Very important. What is something you had to implement in your business as a result of working with passive investors? And it sounds like it was the investor portal right now.
So yeah, right? Something we had to implement to work with passive investors.
Yeah, because you started scaling, and is there a software or product that's helped your business scale?
Yeah, there's a number that we've looked at and used. Some have been better than others, obviously. I really like eVest. E and then VEST. Really great service for 506c funds. They make it really easy. We actually really like them. It keeps it clean. Investors like to have a portal. My first and second funds though, we didn't have an investor portal. We didn't use any of that. We just did we'd send out notices and things like that. And you don't need to have a portal, but a lot of investors now it's kind of like, hey, we're in the tech world. Let's at least have a portal or something set up, and so that we can see what's going on. So we have that going on. I really like eVest though. They've been a great company to work with.
Yeah, awesome. Thank you for that, because a lot of people usually come on and say, the CRM system has really helped us with communicating with investors and such. And I'm sure you got that into place too. Now, what kind of impact has the investment opportunities had on your investors? Have you noticed a difference?
Between my two funds, different investment opportunities, or just in general?
In general, or if you want to break it down and isolate it between the two funds.
Yeah. First thing, it's a lot of liquidity right now. Everyone's got cash. A lot of smart money, a lot of dumb money out there, and it's good for us, right? It's good for fund managers. We can go tap into a lot of that, right? And so we can get into that and get money. So, and I see a lot of it's actually I learned this yesterday. I didn't know this. Literally yesterday, 40 million new investors are on the markets just in general. That's what they calculate. About 40 million new people have invested in the last 12 months, which is insane. Now that doesn't really affect us because we're usually dealing with higher net worth individuals. But what that means is there's this whole new generation that are gonna be accredited investors, hopefully pretty soon here, and maybe whatever it is. But there is a huge trend of investing, and people, I feel like right now, it depends on your investor. It's going to vary differently depending on who you're talking to. But I feel like in the last year, have talked to more investors with a much higher risk tolerance than ever before. I mean, I talk to investors they're not looking for the 8%, 10, even a 12% kind of yield return, cash flow funds or business. A lot of them are looking for the crypto 400% in a year. And so we've actually adjusted our fund we feel like in a little bit riskier asset class. We're going after big box stores, old, dead, distressed retail. We're going to fix them up and flip them essentially, in the most basic sense. But investors, I think, have a higher risk appetite, at least today. That's what we've seen, and are willing to bet on a whim on some projects. Now, it's going to depend on your fund you're offering, but I've just seen a lot of the funds we've worked with too I'm like, man, that's out on a whim. And they go out and raise. I had a guy just on the phone with, he's one of our groups, just raised $50 million on a fund that I thought was kind of on a whim. They raised it in the last 3 months, 50 million, brand new VC fund. They're going into a really niche space, first time fund, 50 million they raised in about 2.5 months. And that's what I see. I see a lot of investors with higher risk tolerance right now.
We interrupt this broadcast to bring you this special message.
Hey everyone, if you manage your own rental properties, aren't you looking for a more sufficient way to streamline your to-do list and make the leasing process easier? Apartments.com lets you list your units, screen and receive applications, create leases, collect rent, and track maintenance and expenses, all on the #1 rental network for free. That's right, for free. Apartments.com isn't just for apartments. 29 million monthly visitors visit the site for all types of listings, like single-family homes, duplexes, condos, and townhomes. Renters view these specific listings over 100 million times per month. This valuable exposure and a robust suite of resources are available to you as a landlord for free. And it's all online, so you can access this information anywhere at any time. If you're ready to find the perfect tenant, get started today by listing your units on the #1 rental network. Go to apartments.com/John Fortes. That's apartments.com/John Fortes. Why not take advantage of the free tools right at our fingertips? Go to apartments.com/John Fortes. It's free. Wow. That's really great to know. Now, when it comes to raising capital, right? What do you do now that you wish you knew when you first started?
Stop trying to do it myself. Like and that's a simple answer, but 100%, like my first 2 funds, I raised all the capital myself. It's me, myself, and I would do everything. And I'm an okay salesman. I'm okay at doing this, but our new fund, I've got 2 incredible partners. And the capital raising is so much easier because they've got these, we tap into their networks. They're great. I mean, it's just like, why am I trying to do this all by myself? And, great teams there's a reason every company's a team, right? And you can't do this alone. And I think for too long, I tried to do this by myself because I wanted all the equity and the control. And I saw that actually with my dad's funds. He's the same way. They were a small fund at the beginning, $10 million, $12 million. And they brought on 2 partners that took them to 500 million within a year. And then another partner that took them to about 3.5 billion the next year. And then they've just raised money like crazy. And you see it directly from I would say, stop trying to ask, how do I do this, and find who. It's not the how, it's the who. That's what I would say as a quick answer.
Absolutely.
Yeah.
No, partnerships are vital in scaling and growing your business because, one, you expand that network as well. And 2, it's a little bit of help, right? So you get yourself to be able to focus on the important things, and it's about who you know at the end of the day. So I relate to that. So you have a Facebook community. You touched on it earlier. I jumped into the community about a year ago. Prior to this interview, I got a couple questions from a couple people that wanted some answers from you direct. So
Great.
I got Justin Dickamore. He asks, do investors use high cash value life insurance as part of their investment strategy? And do fund managers look at this as an opportunity to make greater returns?
Yeah, I love the question. And just to clarify too, is he asking, do fund managers, like as a limited partner, can they use that money to put into funds?
Yes, I believe that's how he intended it to come off.
Yes, gotcha. Okay. So there's this kind of plays into 401ks, retirement plans, insurance policies. Now, in general, now it's going to depend on your policy. Sometimes they have certain rules and regulations, things you can't do. It depends, but I'll say in general, funds, when you're managing a fund, you cannot take more than 25% of your total AUM cannot be from 401ks, retirement plans, insurance policies, things like that. However, though, still 25% is great, right? And so that's a great place to go. That's a lot of capital that people have sitting in those areas that have found out, hey, I'm looking for a higher yield than what I'm getting out of these accounts. And I want to, maybe they have to pay a penalty to pull them out, whatever it is, but I want to put some money into alternative assets. So 100% you can do it. Yes. I would ask the investor to make sure to just check with their provider, whoever they're working with, to make sure it's legal. And then make sure you don't take over 25% of your total AUM does not come from that asset class.
No,
John,
I agree.
To add on to that? You're smart in this too. Anything to add on that?
Yeah, absolutely. So with IRAs, it depends. If they have a 401k from their job and they left that job to go start another job, I feel that investors should never roll it into their current employer. I think they should put it in their own hands and roll it into a self-directed IRA so that they can utilize it anywhere that they want. That's my opinion. As far as the whole life insurance policies, you can borrow against it and invest. I think that's a wise strategy for investors. I think that's a great avenue. And I have investors personally that use that strategy as well. And I use that strategy as well. So I think that investors in general are going to pool capital from wherever they can. And as a preference from a fund manager perspective, I think it's important to say, advise your tax accountant, because we're not tax accountants. Yeah. We're not tax professionals. So always include that disclaimer. So I love what you said as well, man. I think you hit it on the head.
So one thing to know there too, is kind of off topic, but Mitt Romney, when they were doing, he's running for president, they did the whole thing and they were looking through his Roth IRA and he had over $100 million in his Roth. Did you see that?
Yeah, absolutely. He uses that to invest. Yeah. And it's crazy how much he's stacked in that.
Oh, it's awesome. And you kind of ask, well, how, like, you can only contribute, what is it, like $40,000 a year, something like that with a spouse, whatever the number, I can always forget the number, whatever it is. But yeah, a lot of those people will put it in there, do very risky early stage, VC, whatever you want to call it, seed funding or a pre-IPO, whatever it is. And then when those make tons of money, if they blow up, I mean, that's all tax-free wealth. And it's a super smart strategy. I love seeing that. And I was like, man, I got to do that. Right. And I saw Mitt Romney. I was like, I'm doing that. I'm setting one up and I'm going to contribute. I'm just going to take, instead of just investing into the S&P 500, take that money. That's like your gambling money every year. It's not that big of an amount, 50 grand, 100, whatever it is, and put that into some really great, potentially high yield areas where you can, really hit a home run. I think it's a cool concept.
Yeah, absolutely. There's a difference between with those funds, or I guess you can call them products, right? There's a difference between contributions and proceeds. So any proceeds goes tax-free. Contributions is capped. So proceeds is unlimited. So there's the difference right there. So that's why, like you said, if it blows up, the proceeds from that investment, it's off the charts, and it can scale it to however much you invested and made off that, right? So if you got a crazy return, it's going to be that. But as far as contributions, you're probably capped at, whatever they tell you at. Yeah. So yeah, that's great that you broke that down. Now I have one more question from Kumar Ashwa. He asks, how do fund managers get proof of funds? Should I get a term sheet after getting soft commits?
It's a great question. I'd love to hear your thoughts too. You mentioned that question earlier. I've thought about that before, but typically the investors, when they're going to write down on a subscription document, hey, I commit $1 million to the fund. Usually I'm like, okay, they must have $1 million to the fund, because there are very steep penalties in a fund if you do not meet a capital call. So if you say, hey, I'm going to commit $1 million and you miss a capital call or contribution, you just don't have liquidity, whatever it is, most fund docs will say you lose about 50% of your capital commitment in the fund. So it's a very steep penalty if they are lying or if they don't have liquidity. A lot of funds I'll see, depends if it's an open-ended, closed-ended fund model. It's going to depend on the board, but most of the time when they receive a subscription document, they will typically call down initial capital. Maybe it's 10%, 15%, whatever it is in the fund. And if you issue another capital call and they don't fund it, or they were lying, or don't have the capital, they are subject to lose 50% of their capital. So that they would, they've lost now 150 grand or 100 grand. I think most people don't want to do that, right? And that's why you have that steep of a penalty inside your subscription documents, so that people don't jerk you around and just write down numbers. It's a very steep penalty if they are lying, or if they, most people aren't lying, I would say, but some people just get a big margin call, or they have liquidity crunch and they can't hit a margin call, or a capital call. And that's typically what happens, but you got to make sure that they're clear, your investor, because you can't miss a property or a deal because someone misses a capital call. You can't have that happen in your fund. So there's usually a steep penalty there.
Nah, I'd like to add to that as well. I think you hit it right on the head. There's a couple avenues that you can choose to. If you have the soft commits, you already got your documents drawn. And for instance, our structure is we have a 90-day grace period before we start issuing the return on the pref, right? So if we can call down the capital, put it in the escrow, now we can show proof of funds. Also, a little cheat code might be, I got soft commits, I'm ready to go. If that doesn't work, you can use your soft commits as well as an opportunity to go ahead and get a line of credit on your fund. Now, that's another alternative too. It's a great strategy that fund managers could use. They can utilize the fund, the line of credit first in an investment, call down the capital. But what happens is, or even before that, here's what I do. Line of credit, you use the line of credit, you make the investment, call down the capital from the investors, wait before you pay off the the line of credit, burn it off. What it means is ride it all the way to the end of when you need to return the capital to the line of credit, to the bank. The reason why is that's cheap money. The line of credit might be 2%, whatever you're getting from the bank. Now burn that off, ride that, and kick back the investors the returns. The reason why is you're building momentum for your fund in case there's ever a catch up on the pref or the preferred return. So that's a strategy as well, using the line of credit. And the reason why I brought that up and explained that was because you could use that as a part of the proof of funds. There you go, Kamar. That's our opinions. I hope we exhausted that one, man. Bridget.
I love it. No, the line of credit's huge. I think for a liquidity crunch too. I mean, you want to be able to transact. That the best thing about having a fund is you can transact, and you'll build a reputation as a person who can transact. A lot of funds will win deals over other bidders. Sometimes, like real estate's a great example, because they have the ability to transact, they have that reputation, and they'll sometimes win a property for 4% or 5% cheaper because that ability. And then a line of credit's a great avenue if you can set that up, depending on your fund, what you're doing. Great point, John.
No, I appreciate that, man. I mean, it's a process to do though. So it's not that easy, but it's a process to do. But if you can get it, it could shave time off your investors' returns, man. I'm telling you. Bridger, really appreciate you. How can we stay in touch with you?
Yeah, my name's Bridger Pennington. So if you find me on Instagram or YouTube, Bridger Pennington is a great way to find me. Shoot me a DM on Instagram. We can talk more. Our stuff is called Investment Fund Secrets. So investmentfundsecrets.com or Investment Fund Secrets, or we have a Facebook group that you've joined apparently, which is awesome. And you can find our stuff there. We have programs and whatever, all sorts of stuff in there, which is fun. So that's our way to find us.
Nah, no worries, man. And this is my favorite question. And what is the meaning behind your company name? I know it's real simple and basic, but please dive in.
Investment Fund Secrets is we're trying to pull back the curtain on this secret world of funds. And you're doing the same thing. I mean, there's just a lot of people don't know about this world. No one talks about it. No one preaches it. And it's like, this is one of the most lucrative businesses on the planet. Let's at least learn what it is and maybe even start our own, right? And even we could scale through it, right? And I think it's valuable for people that want to start funds, obviously, but even people that are interested in just the space, being able to, in your next job interview, talk the language of funds, or to your business partners, talk about how funds work. Because if your business is doing well, you're going to be playing with funds a lot. Whether you have one or not, you need to understand how this world works and how capital is moved at the highest levels. And that's why we call it investment fund secrets. That's we're pulling back the secrets of all the investment funds. That's the plan.
And I resonate with that because as a syndicator, it's very transactional. Creating a fund allows me to literally grow my investment firm. And that's what we're here to do. We're trying to help other firms grow. We're trying to help investors understand the process of coming through a firm and how to invest with a firm. So I really, really, really appreciate you sharing that, man. Bridger, thank you for stopping by the show today, man. We really enjoyed the conversation.
John, thank you so much.
Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.